India's aviation sector has earned a reputation as a graveyard for airlines, with numerous carriers giving into financial losses and ceasing operations over the years. From the early pioneers like East West and the Mania in the 1990s to the dramatic collapses of large players like Jet Airways and Kingfisher, India's aviation graveyard is crowded. In fact, 13 airlines have shut down in the last 2 decades, highlighting the volatile nature of this industry. In this firestorm, one airline stands as a notable exception: IndiGo. InterGlobe Aviation Ltd. Redefining the rules of aviation in India, IndiGo has not only remained profitable in a volatile industry, but is also dominating the skies, cementing its position as the leader in Indian aviation. IndiGo's remarkable performance is reflected in its share price. It has delivered a return as of May 16, 2025, a remarkable 553% gain since its listing in November 2015, a CAGR of 20.5%. In April 2025, IndiGo made history by briefly surpassing global giants like Delta Airlines and Ryanair, becoming the world's most valuable airline with its market capitalization soaring past 2 lakh crore rupees. So how did the company do it? What did it do right to avoid the fate like other airlines in India? Welcome to Bottom Line by Groww. In today's episode, let's look at IndiGo's business model. What has it been doing and its future prospects? What's new with IndiGo? India's aviation sector is on a high growth trajectory, and IndiGo is well positioned to lead this journey. As the country emerges as the world's fastest growing aviation market, passenger volumes are expected to double by 2030. IndiGo, already the dominant domestic player with nearly 65% market share as of March 2025, is strengthening its foundation for the next wave of growth through multiple strategic initiatives. One of its most notable moves is the rollout of its new business class product, IndiGo Stretch, on metro routes such as Delhi, Mumbai and Delhi, Bengaluru. This premium service has been well received and is expected to be deployed across 45 aircraft by the end of 2025. IndiGo is exploring new revenue pools while maintaining its low-cost DNA. In parallel, IndiGo is aggressively expanding its international footprint. As of FY25, 28% of its available seat kilometers, or ASKs, are deployed on international routes, double the share from FY18. As of FY25, the company caters to 40 international and 91 domestic destinations. This international push isn't just about geographic diversification. It also helps generate revenues in foreign currencies, offering a natural hedge against forex volatility. Long-haul markets is a core part of this strategy, reflecting IndiGo's growing ambition beyond domestic skies. Another initiative that InterGlobe Aviation Enterprises, the parent company of IndiGo, is venturing into is hospitality to capture greater share of the travel ecosystem. In partnership with Accor and Treebo, it plans to develop 300 hotels over the next 5 years. By 2030, this venture aims to operate 30,000 rooms, cementing IndiGo's evolution from an airline into a broader travel and lifestyle brand. Risks to the company. While all these initiatives could significantly boost the company's revenue and could help cement its market position, like every other airline operator, IndiGo also faces multiple risks that could impact its long-term growth. Number 1, issues related to aircraft operations. For instance, in Q2 FY25, the airline posted a net loss of 986.7 crore rupees, the first quarterly loss in nearly 2 years. This sharp setback followed multiple headwinds, most notably engine-related issues stemming from faulty Pratt & Whitney engines. At one point, more than 70 of IndiGo's aircraft were grounded, forcing the airline to resort to expensive short-term wet leasing, or ACMI, which is an arrangement where the airline leases an aircraft along with its crew, maintenance and insurance just to keep operations running. These disruptions led to a steep increase in the operating costs. IndiGo's cost per available seat kilometer, excluding fuel and forex, jumped 22.8% YOY in September 2024. Lease expenses spiked by a staggering 290%, while maintenance and repair costs also surged, straining margins. In addition to leasing costs, IndiGo also faced rising maintenance and repair expenses for its grounded aircraft, further intensifying financial strain. Another risk is from non-fuel operating expenses, which drive up costs, particularly airport charges. Fees for landing, parking, and terminal navigation have all seen significant increases during FY25, further impacting the airline's financials during the period. For instance, charges have surged at major airports like Bengaluru, Hyderabad, Chennai, Kolkata, and Kochi, ranging from 2 to 200%. This had led to a 41% YOY increase in airport fees and charges. That said, in Q3 FY25, recovery was seen with net profits jumping to an increase of 346.9%. The festive period and year-end holidays fueled a rise in consumer spending, driving strong travel demand. This surge resulted in load factors consistently exceeding 90% in the domestic market throughout November and December. As a result, IndiGo achieved a record-breaking 31 million passengers in the December quarter, reflecting a 13% year-over-year growth, which contributed to its increased profits. Another operational risk is in terms of employees. The industry is currently grappling with a shortage of pilots, engineers, and cabin crew. Fatigue and burnout among pilots have raised red flags, potentially affecting both safety and efficiency. To tackle this, the company has partnered with aviation academies to train interested candidates. This would ensure retention of skilled crew members. Number 2, currency depreciation. With nearly 40% of IndiGo's expenses dollar-denominated, covering fuel and leasing and maintenance. A weakening rupee has significantly inflated costs in the years and directly impacted aviation companies' profitability. For instance, in Q3 FY25, the impact of the depreciation of the rupee can also be seen in the increase in forex losses, which have reached a staggering 1,456 crore rupees. But as IndiGo expands international operations, foreign currency earnings could increasingly act as a natural hedge against rupee depreciation. Number 3, fuel prices, a major wildcard. Aviation turbine fuel costs rose from 63 rupees per litre in FY20 to 102 rupees per litre in FY24, eating into margins and profitability. Fuel constitutes 35 to 40% of airline costs. Industry-wide projections suggest Indian airlines could face collective net losses of 2,000 to 3,000 crore rupees in FY26, reflecting the ongoing structural and macroeconomic risks. Number 4, geopolitical tensions. The recent Pahalgam attack, which led to a closure of airports and grounding of flights in key regions, have increased international flight time and operating costs, adding approximately 77 crore rupees in weekly expenses for Indian airlines. What has helped the company sustain its performance? Despite multiple challenges over the years, IndiGo Airlines has managed to survive, thrive, and become a dominant player. 3 key factors have helped the company over the years. Number 1, operational efficiency. IndiGo's low-cost, no-frills business model is built around offering affordable fares and on-time performance. Unlike full-service carriers like Air India, IndiGo avoids unnecessary add-ons, allowing passengers to customize their journey through paid services. This strategy ensures high asset utilization, quick turnarounds, and a lean cost structure, making the airline both efficient and scalable. Number 2, sale-and-leaseback strategy. A cornerstone of IndiGo's financial strength is its sale-and-leaseback model. The airline buys aircraft from Airbus or Boeing, sells them to leasing firms like BOC Aviation, and then leases them back. This generates upfront liquidity, reduces capital expenditure, and improves tax efficiency by keeping the aircraft off the balance sheet. It's a smart way to maintain a modern fleet while preserving cash flow. Number 3, hub and spoke network and smart fleet orders. IndiGo's hub and spoke model allows it to centralize operations at strategic airports, enabling greater connectivity with fewer aircraft. This network design lowers operational costs and boosts aircraft utilization. Further strengthening its cost advantage, IndiGo has consistently placed large aircraft orders, starting with 100 Airbus planes in 2006, with discounts up to 50%, and a record 300 A320s in 2019. These bulk deals reduce procurement costs and secure long-term support from manufacturers, reinforcing its leadership position. IndiGo's sale and leaseback strategy and hub and spoke model have been key drivers of its strong operating cash flow.
In Q4 FY25, IndiGo's recovery story took another leap forward. As travel demand surged, the airline posted a total income growth of 24.8% YOY. Against this backdrop, net profit surged 61.9% YOY, lifting the profit margin by 320 basis points YOY to 13.8%. Behind the positive results lay a powerful operational comeback as capacity expanded by 21% to 42.1 billion seat kilometers. Moreover, the revenue per available seat kilometer stood at 5.6 rupees as against 5.14 rupees in Q4 FY24, whereas the cost per ASK or ASK was at 4.5 rupees against 4.62 rupees in Q4 FY24. CEO Peter Elbers summarized that IndiGo will continue to build on this momentum while maintaining its focus on cost leadership and accelerating its international expansion with European operations.
Investors' takeaway. While the company's fundamentals remain strong, the stock's valuation is currently flashing a caution sign. As of May 16, 2025, IndiGo's price to earnings ratio stood at 35.4 times, well above its historical 3-year median PE of 23.2 times. The premium valuation reflects high investor expectations, especially around international expansion and premium services. However, it also leaves little room for earnings disappointments. Moreover, despite the strong growth in operating cash flows, net cash flow in FY24 turned negative at 555 crore rupees. This was due to higher debt repayments and rising fuel and leasing costs, indicating growing financial commitments that could limit flexibility in the near term. So for investors, this means balancing IndiGo's strong runway for growth with a careful watch on valuations and execution, as stock derating can happen even in the case of a minor fallback. Remember, the Indian airline industry has a history of challenging even the strongest market leaders. How do you think IndiGo will navigate these hurdles and maintain its dominance? Share your thoughts as comments. For more such insights, subscribe to Bottom Line by Groww.
Investment in securities market are subject to market risks. Read all the related documents carefully before investing. Please read the risk disclosure documents carefully before investing in equity shares, derivatives, mutual fund, and/or other instruments traded on the stock exchanges.